So, some fancy app told you that you have a good credit score and now you're ready to go out and take on the world. Congratulations. You have a 700, 7 plus, 720, 740 FICO score or Vantage score, and now you believe that you have the ability to go out and apply for whatever you want, get the best rates and the best terms with no questions asked. This video is made to be a reality check and an educational moment so you can actually know what real power is with your credit and where you need to be focused to have the confidence to go out and apply for credit and have the ability to know that you're going to get approved and most likely at the best rates and terms. Your credit score by itself is not actually it. Let's talk about it. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you reach your customized blueprint for prosperity. So, many of my clients that I work with personally and many of you out there who fit a similar bill believe that just because your credit score can be a 700 or above or a 720, 740 and above, that automatically means that you're able to go out and finance or borrow whatever you want. You have the ability to get access to any amount of capital, or you can go get any car or even take down a home because you have this score. And I'm here to use this video to be a little bit of a cold shower for some of you who may be confused about the real value of your credit and what you're really graded by when it comes to your credit and what role your score plays versus the actual other data points that are used in underwriting processes. And this is coming again from a financial professional, not just a YouTuber. So your credit score is basically going to be a benchmark measurement for determining interest rates and can play other roles in underwriting, but it largely is a determinant of the cost of the money that you're borrowing. And that is very important. It is very important for sure. Your credit score, the number itself, is tiered for many lenders and underwriting. In the underwriting process, is tiered off, and they're willing to see a certain tier be more or less risky, right? So basically, if your credit score is at a certain point or below, you're considered highest risk. If it's at a certain point or slightly above, then you're a lower risk or a moderate risk, and it goes all the way up to you're considered a prime borrower or a low risk borrower. And this is what's going to help that lender determine how much they're going to charge you to lend you the money on whatever you're looking to borrow on. But many of you think that just because you have a prime credit score, 700, 715, 720 plus, that in itself will kick the door open to you being able to walk off the lot with a Lamborghini, even though you only make $15 an hour, or thinking that you can go take down $1 million mansion, even though that your debt to income ratio may be negative or upside down. It doesn't work that way. Your credit score is literally just going to factor in how much you're going to get charged on the money you may get approved to borrow, if you are approved at all. In reality, your credit profile, income, and debt to income are all equally as big determining factors on actually getting approved. Your credit score is only determining, if you get approved, how much it's going to cost you. So your credit profile is a different beast because there are many cases out there with people who have really good credit scores and horrible, or at least unappealing credit profiles. I won't say horrible, but they're just not appealing to lenders. So you could have a 720 or a 740 credit score and literally only have one trade line on your account. One credit card, one loan, or two loans. That's a really bad credit profile. It's bad in the sense of you look high risk. There's not enough data, nowhere near enough data there for most lenders to trust you enough for any significant financing ventures. So we're talking about, financing a vehicle, financing a home, financing rental real estate, business credit, and we're in these big, the big boy brackets, if you want to call it, the big girl, big boy brackets. You can't go to a lender with 1 or 2 trade lines or primary trade lines on your account, like a credit card that's a year old and a student loan that you've been paying on for 3 years, and expect somebody to lend you $250,000 on a home. It's just not going to work. And it's important for you to understand that you need to have an actually strong profile, because on the flip side of that, you have the 720 and you only have 1 or 2 trade lines on your profile and get denied for a car or get denied for a home or business credit. But then you'll turn around and have somebody with a 640 who has 35 different trade lines on their account that are all in reasonable standing, or they may have a couple late, a couple charge-offs in the past 3 or 4 years ago that's wearing their score down. And they may have to pay a little bit more. They have to pay more for the cost of their money, but they'll get approved and possibly even at a high limit because they have so many data points. You have 2, they have 35. So a lender is looking at risk, and your score is only giving them a benchmark of what they would charge you if they approved you. It is not guaranteeing your approval. There are many other data metrics helping to determine your qualification for said loan or said credit card or said car loan, whatever the case may be. So this is an important wake-up call for many of you out there who are not that versed in finance, but you're out here obviously participating in the economy, you're borrowing, or you're trying to build your credit to go borrow, or you've done it already and you're bumping your head. You need to have a strong credit profile. Again, I've shot several videos that you guys can go back and watch talking about the fact that you're not playing the game right. Many of you aren't playing the game right. You have to participate. You have to have more and more data points for lenders to feel comfortable that they know your pattern, your behavior as a borrower, as a client. So you need to show yourself to be less risky by having a longer track record. Your credit score is not going to cut it by itself. Just dropping some game for y'all, dropping some gems. Like the video, subscribe to the channel. This is JP from Blueprint for Prosperity Network. Checking out. Stay focused. Stay in motion. I'll see y'all in the next one.